He's Trevor Greetham, Director of Asset Allocation at Fidelity Worldwide Investment. Trevor, good morning.
Good morning, Mark.
You've had 3 days to digest the events in Brussels on Friday. Did you wake up today feeling that Europe was a better place to put your money or a worse place to put your money?
I think the whole thing's rather surreal because in the markets we've got a liquidity problem and we've got an economic problem. The fact the South is uncompetitive versus the North. And what the summit seemed to be all about was coming up with rules for balanced budgets in some imaginary future good time. And it doesn't seem very related to the problem in hand at the moment.
So the core issue is lack of competitiveness, which wasn't dealt with. You'd like to hear that dealt with, but that takes time in itself, doesn't it?
Well, it does take time, and we're all very impatient. So I guess people were hoping that some kind of fiscal agreement would result in short-term, more aggressive action by the ECB. But that's more or less been ruled out. And in fact, before the weekend, that was more or less ruled out. So I don't think we're going to see the sort of, ECB piling in that people were hoping for.
Is that the one sort of bazooka that you're realistically waiting for? Is that the big thing that they can pull out of the hat?
I think the markets want to have some kind of unlimited, unconditional commitment that the euro will survive. And it's very difficult because there's no one operator who can make that commitment at the moment. But central banks typically are the ones that can make an unlimited commitment. But even if the ECB wanted to make an unlimited commitment, it can hardly make it unconditional because the whole point is they need to see the countries in the South deal with their budgets.
What does it take then, Trevor, for the ECB to say, you know what, forget the treaties. We're going to start buying big time.
I don't think they're going to do it. I think what they're going to do is they're going to keep the banks liquid with massive force, and that's where they will use as much force as they possibly can. But I think the sovereign debt problem is here for a while. Unless bank regulators can sort of step back from making everyone mark this through and raise capital on the back of it, I think the connection to the real economy is still there. I think Europe's going into recession.
But so it seems as if the answer to my initial question, is Europe a better or worse place to invest your money? It might actually be a worse place, but you still say that 2012 could be V-shaped, but there is a caveat. If the Eurozone crisis sorts itself out?
Well, I think one way or another, things are coming to a head. So the good news globally is that global growth is slowing down and inflation is also falling. It's peaking. So we've got lead indicators for inflation that suggest it will fall quite rapidly. And that means at least central banks are trying to get things moving again. So we're seeing rate cuts, we're seeing money printing, obviously, in various places, even the ECB cutting rates. And I think the crisis in Europe will probably carry on. And at some point, there'll be more aggressive action. My feeling is it's only political union in Europe, full burden sharing, that will end this. We might get periods where for 12 months things pick up globally. But I think the markets want a single person to pick the phone up to. They want a single country. Within
Europe then, I mean, I know you don't like the euro in 2012. What assets within Europe are worth choosing next year?
Well, at the moment, I would position more defensively. So UK government bonds, even though they yield almost nothing, they still yield twice as much as their equivalents in Japan.
Yeah.
So there's money to be made there, I think, and they're a safe haven. If Europe goes wrong, I think it's a cleaner play that you'll make money on UK government bonds than trying to extract something from the European bond market. If we get the turnaround, and there are some positive signs already in the US economy, things are picking up, then I think it would be a mixture of equities and commodities.
In a word, did Cameron do the right thing?
I think he had very little choice.
And you've warned that emerging market economies such as China will be unable to underpin global economic growth next year. What's the reasoning?
Well, you mentioned the export sensitivity. I mean, China's domestic economy is growing very rapidly, but its export sector is still very large as a share of GDP. And the euro area, including the UK, the European Union, I should say, is a larger economy than the US economy. And we're not used to the fact that the world's outlook could be driven by Europe as a swing factor. But if Europe heads into a recession, it's going to affect exports from China. And we're already seeing signs of a domestic property slowdown. So I think things are cooling off for a while.
So how do the emerging markets fit into our asset allocation strategy in 2012?
Well, they have some very good long-term attractions. So in terms of their sort of fiscal position, they're much more solvent than developed economies. And when we get to that second half of the V, when policy has been thrown at the problem in the developed markets, it's probably the emerging markets that lead the way up. But remember, in 2008, it wasn't a great environment to be holding emerging markets overweight. So we're neutral to slightly underweight, and we'd like to see signs of the developed economies picking up again before we move back in aggressively.
And in the meantime, I mean, you favour bonds overall. In the meantime, you favour bonds over equities. You underweight commodities.
Yeah.
Gold is an exception. But within equities, you do favour the US, but the US has its own problems. Why are you overlooking them, or are you not?
Well, the US has got a central banker who likes to print money.
Right.
It's got a president who actually wants to expand fiscal policy and hasn't so far tightened it. So in terms of the sort of drivers of stimulus, it's got more going for it than most other places in the world. And I'm not convinced that balanced budget amendments everywhere are the way forwards, actually. So I think fiscal policy has a part to play. And although there's a big standoff between the parties at the moment, America is actually extending unemployment insurance benefits.
And when you say you favour bonds over equities, where exactly and what type of bonds?
Well, primarily government bonds. UK government bonds are a good place for a UK investor to put their money. And I really don't see any risk of UK bond yields rising as they've done, say, in Greece, even if we go off target with the fiscal adjustment.
Which we sort of have done by a couple of years. I mean, is that a worry or not? I mean, what happens if we put it back even further?
I personally think that government should be spending money because no one else will at the moment. So we can borrow at just over 2% in the UK, and we can invest in infrastructure, and we can make more return than 2%. So we'd actually be doing our children and our grandchildren a favour by borrowing at such low interest rates. So I'm all in favour, actually, of more fiscal stimulus if it's to boost growth. But I don't think there's any risk that gilt yields would rise dramatically if that happened, because I think we're much more at risk of being Japan than Greece.
Are there any temptations, Jeremy, within the European government bond market or not?
Within the
in non-Eurozone, should I say?
I don't know what Jeremy thinks, but
Trevor, within the Eurozone bond market.
Within the Eurozone bond market, we're very much overweight German government bonds. So we think that that's a sort of true sovereign bond yield in Europe, and all the other bond yields are built on that with various sort of risk premium for default.
Steer clear of the periphery?
We're clear of the periphery.
So
it's UK gilts, it's German government bonds, treasuries we'd be happy with as well.
And just coming back to the commodities call, not a big fan, but gold, I mean, that's a bit unadventurous, isn't it?
Well, do you know, I like gold within commodities because in a slowdown environment it tends to outperform. But as an absolute play at the moment, I'm not very aggressive because you've got to believe in a weak dollar to really pile into gold, and we think the dollar could continue to strengthen.
Yeah, Trevor, thanks very much. And gold is up. You can see that chart a little bit there. Thanks, Trevor. Trevor Greetham there, Director of Asset Allocation and Portfolio Manager at Fidelity Worldwide Investment.